Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the region are making cautious gains with trade once again the key focus as mainland markets reopen. After a holiday, now bonds are falling as the dollar hovers around 2023 lows.
The White House says Presidents Trump and Xi are likely to speak this week as tensions flare up, but there's been no confirmation yet from China.
And also ahead here and shows how a slow-moving shopping mall project near Hong Kong airport is adding to debt concerns for developer New World.
And I'm Sharian in Seoul, where voters are choosing a new president. The winner will face the challenge of reuniting the country after its worst political crisis in decades.
Good Tuesday morning from the Asia Pacific. We're still tracking in terms of markets here. The sort of backdrop is again still a weaker dollar. Friday, Monday, and that big drop that we had in the dollar. And this is where we are. Still some weakness coming through across the dollar. So we're approaching these 2023 lows in the Bloomberg Dollar Index. Flip the page, please, about 0.7%. Reason that's important, it is indicative, as you can see here, of equity markets that are on the front foot, albeit, of course, ever so slightly as far as risk appetite is concerned. You have Japan, of course, will be with Sherry in a moment, of course, on the ground in Korea. Korean markets are shut, as with Thailand. A bit of steepening, as you can see, in the yield curve, 2s and 10-year yield there. Although, broadly speaking, you are seeing, of course, bonds on the decline. Gold is on the way up, and, of course, not on your screens, but oil is tracking the gains we are seeing in equity markets. Right. Very quickly, we are reopening today as far as mainland markets go. Long weekend there, so we'll see what happens there. In terms of the 50-day moving average, we'll talk about this later. Hang Seng Index, in fact, at one point yesterday bounced off that, hit that session low, and then we closed not quite completely in the green, but certainly reversed most of the losses there. A tenth of 1%. We're at 171 right now, the Chinese 10-year yield. And as you can see, we're stronger on the Chinese currency, but we are still on the weaker side of the cutoff of the Hong Kong dollar, and we are approaching again the weak end, Yvonne, of the trading band here in Hong Kong.
Yep, I certainly want to watch here against that dollar weakness. And in terms of the agenda here today, as Dave mentioned, it is the markets reopening in the mainland. That is what we're going to take a look at. Futures are slightly lower, higher, I should say. But keep in mind, yesterday we did see quite a bit of a broad-based sell-off here in Hong Kong. So maybe we'll see a bit of a catch-down story here today. We do have, of course, the HSI and that 50-day moving average to tell you about, and the Caixin China PMI numbers coming out later on this hour as well. New World is still the big corporate story out there after some of these perpetual bonds briefly touched those record lows. We see a bit of a rebound yesterday in the late session. We'll see how the stock as well as these bonds go here. And earnings, NEO is the next in line here as, of course, we get closer to the end of the earnings season in China. And again, yes, Hong Kong dollar weakness, Dave. Yeah,
okay, lots to track as we go into today, but it's the same story really when you talk about the trade conversation, the impasse there that so far re-emerged from late last week. And certainly when you go into today, the White House is saying that President Trump is likely to speak this week with Chinese leader Xi Jinping as the two economies remain locked in a trade turmoil.
I can confirm that the two leaders will likely talk this week. And as always, when there are foreign leader calls, we will provide a readout of those calls. So we'll see you guys later. Thank you.
And let's bring in Min Min Lo, our China correspondent, with more on the story. And how open really is China to having this call quite so soon?
Yeah, well, I was scanning Chinese state media today, and I haven't seen any pieces discussing the prospect of a call between President Xi and Trump. And of course, we haven't gotten any official confirmation from the Chinese side, although, of course, many times such confirmations from the Chinese side usually come or can sometimes come really late, maybe just maybe a few hours before the call or even the day before. So it's hard to say. We still have a couple of days before the end of this week. We'll have to see. But we know President Trump has said he's confident he will be able to clear up these tensions in a call. But China, from past tradition, they tend to favor having lower-level officials negotiate key issues before agreeing to a leaders-level call. And they would only agree to that when they are sure that there are some expected outcomes that they can be clear they would be able to achieve. So at this point, it doesn't look like the conditions are very favorable yet.
Yeah, it seems like the U.S., though, is hoping for some sort of call and really in some ways showing some urgency as well. What are some of the key issues do you think the president wants to raise?
Yeah, well, the U.S. has raised the issue of how China has been very slow in rolling back some of the non-tariff countermeasures that they promised to do at the Geneva summit. And in particular, they're concerned about the flow of critical minerals. They said that that has been slow. And when it comes to China, these exporters, they have to apply to the Ministry of Commerce for permission. And it's a process that can take a while. It's also a process that is quite opaque. It's not really visible to outside parties. So it's something that the Chinese ministry could possibly turn on and turn off as they wish without really a lot of transparency. So the U.S. is saying they're not clear. Is it intentionally being slow or is it because of backlog, administrative backlog? So that's the issue there. But for China, there are a lot of other issues they're unhappy about, ranging from the expansion of chip curbs to the revoking of Chinese student visas, limiting the sale of these critical parts that are used in jet engines. And Reuters also reporting that U.S. is preparing to step up military arms sales to Taiwan. So a lot of issues that are touching on China's red line that they have made clear of before.
All right, Min, thank you. Min Lo there, our China correspondent on the latest when it comes to these trade talks and whether we'll get them between the U.S. and China. Meanwhile, let's move you to Seoul now. We're looking at live pictures out of South Korea as voting gets underway for a presidential election. A lot certainly at stake here, given months of political turbulence there in the country. And certainly something that, investors really want is some stability in this market. Of course, Korean markets are shut this morning, too.
Yeah, and the exercise today, to Yvonne's point, in some ways is hopefully for investors and, of course, with locally bookends what's really been fairly turbulent few months there for South Korea. In fact, let's get it over now to so on the ground for us is our colleague and co-anchor, of course, Sherry An. She's there with us. Yeah, Sherry, to get us up to speed on, so we know markets are closed, voting is underway right now. Put this into context for us.
Yeah, voters heading to the polls until tonight, 8 p.m. local time. But you guys said it, Korean assets have rallied ahead of this vote. And is that optimism that finally we're going to see an end to 6 months of political turmoil, 3 acting presidents that this country has gone through? I'm here in Yeouido, central Seoul. Behind me, the National Assembly. Remember, this was ground zero back in December when lawmakers were rushing in, trying to get into the building, struggling with police officers, trying to hold that emergency vote to lift the martial law that was declared by ousted President Yoon Suk-yeol. We have now seen 30,000 police officers just across polling stations nationwide. The political drama has been high here in South Korea. We have seen political protesters, really supporters even of President Yoon Suk-yeol, protesting in front of the headquarters of the Democratic Party front runner leading candidate Lee Jae-myung. Of course, that's to my left, about a couple of blocks away. So now finally that's coming to an end. There will be no transition period. Whoever wins takes the presidency right away. He has to get right to work. Of course, a lot of issues right now at play, and the trade negotiations with the U.S. A top priority.
Yeah. Certainly that's what's top of mind for many voters as well. I'm just wondering in terms of just the markets. We've seen actually Korean assets rally leading up to this election, but what is the state of the broader economy now in South Korea, Sherry?
A fragile economy, as you can imagine, given the political turmoil and the leadership vacuum that we've seen in this country. We have seen the Bank of Korea cut rates last week and downgrade the growth forecast for this year to 1.8% to 0.8% from more than 1% just in February. And the fact that we're seeing exports now stalling, we're talking about a contraction for the latest data in May. We are seeing, of course, the trade negotiations ongoing with South Korea, but without a clear president, that has really looked very difficult for South Korean policymakers. So the frontrunner Lee Jae-myung of the Democratic Party has pledged that trade negotiations with the U.S. would be his top priority in the first 100 days of office. But at the same time, he has a very nuanced approach to the U.S., where he wants a solid alliance with Washington, but he does not want necessarily a quick agreement. His rival Kim Moon-soo of the ruling People Power Party wants a strong alliance with the U.S., with Japan as well. He also wants to deregulate. He wants market-driven growth, and he has promised a very business-friendly environment. So we have seen these policies from both sides, all wanting to really support the South Korean economy as we continue to see that fragility across the nation.
Cherry on there, our Bloomberg anchor joining us in the field in Seoul as, of course, we count down to this presidential election in Korea. Coming up, we're going to be live talking with markets with Principal Asset Management and why they're looking to diversification into value, into some of these large cap stocks as well. George Maris joins us in just a few minutes' time. We're also counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. A steamy Tuesday morning here. This is the China Show. Futures are up this morning.
All right, welcome back. U.S. futures looking like this on your screens. European contracts also, as you can see, this is almost a juxtaposition of the big stories. U.S. futures are coming off. European equities are still on the front foot, and also on the back foot is where you are on the 10-year yield. Bottom of your screens coming up very shortly is a 3-day look at the U.S. dollar. Friday, the sharp drop that we had on Monday, and of course the weakness still that we're seeing permeate across the FX markets right now in the U.S. dollar space. Early Tuesday here in the Asia Pacific. Right, let's put this all together for you, what this means for asset portfolio construction. Do we lean further away from the U.S. dollar? Is there value there? Have we thrown the baby out with the bathwater? George Maris is with us right now, CIO and Global Head of Equities at Principal Asset Management. Good morning.
Good morning. Thanks, David.
The notion, why don't we start with the U.S. and how you guys are thinking about this, the world sort of stepping back from U.S. exceptionalism or U.S. exposure.
Right. So I think, look, in the last 5 years and even longer, the U.S. has been a phenomenal market, right? The economy's been outpaced the rest of the world. The markets have outpaced the rest of the world. Yeah. The question is, does that continue to persist? Is there this U.S. exceptionalism that's out there? I would argue that U.S. exceptionalism still exists, i.e., is it still the hub of innovation? It still is, irrespective of all the political chaos and noise. Political chaos and noise is a feature of everything in the world right now. That said, the amount of attention the U.S. has received has really gone overboard. And so if you were to go back, let's say 6 months, 9 months ago, it had became truly, I would call it almost a bubble in terms of the U.S. versus the rest of the world. The valuations had never been that far different, with the U.S. trading at a premium to the rest of the world. Everything in the U.S. was viewed as being bulletproof relative to the rest of the world. That was just wrong. Right? It's still a global economy. There was tons of innovation happening outside the U.S., and so that had to be recalibrated, and I think we're in the early stages of that recalibration. So is the U.S. still exceptional? It's still the hub of innovation. It's still a more resilient economy than much of the rest of the world, but it doesn't have a monopoly on resilience. It doesn't have a monopoly on innovation, and I think those are the opportunities to reallocate capital elsewhere.
Does that mean that, in terms of assets then, can I basically say I can still maybe invest in equities? Maybe not so much bonds and maybe not so much the U.S. dollar? How do you differentiate the different asset classes?
So I think that's right. I think equities, from my perspective, are still a very attractive place to be. If we're looking at earnings continue to be resilient. They look like they're going to continue to grow. And in fact, if you think about policy outside of tariffs for a moment, outside of tariffs, policy will be very corporate supportive, i.e. tax cuts, tax reduction. That will certainly help with respect to most U.S. companies in driving earnings. If you think about deregulation, an extraordinarily powerful influence on driving GDP and corporate growth. Those things may weaken the dollar. They may very well result in higher yields, so hurting both the dollar, hurting both bonds, but certainly supportive of corporate earnings in the States.
What do you think of valuations currently?
So I think we've got to be careful what I mean by valuations. I think if you're looking at the market as a whole, not terribly interesting.
Yeah, index level.
Right. If you're looking at the index, right. But if you're looking at sectors within or different companies within, there's a whole slew of companies that are out there that are massively mispriced for their profitability, their balance sheet strength, and the growth going forward. There's just such a concentration and focus behind a few of the thematic stocks that are out there, right, that it's created this concentration, and those stocks tend to be the biggest cap stocks. So if we think about the index weights, it's driving the index multiple, but the average stock actually can be much more interesting.
A lot of people, there's a lot of talk that what is that alternative? Europe seems to be one of the first things people come to mind, right? The ECB is cutting rates. Germany, you're starting to see more fiscal spending, all the like. Do you think that's going to be the right place to be in Europe?
Yvonne, I would caution a little bit of prudence with respect to Europe, and that is there's a notion that this is the big change that's happening that's long since needed to occur. We're seeing much more spend out of Germany, right? We're seeing deregulatory reforms in the United Kingdom and elsewhere. We're seeing a much greater degree of acceptance of change. What I would push back on is there's still multiple structures within Europe that hinder change. If you think about corporate boards, many times those corporate boards have labor councils on them. The ability to restructure a labor force, the ability to restructure the taxation is very difficult. Entrepreneurs in Europe continue to leave Europe and come to the U.S. And I think that is highly problematic for Europe. They need a stronger set of policies to go forward. So I think you're going to have this phenomenon where everybody gets excited about the change, and then the reality disappoints. Now, that doesn't mean there's not great opportunities in Europe, but the change is decades. I mean, we're decades long in terms of where we are in policy. It needs a much more coherent, cohesive reformation that's difficult to achieve given the current state.
So relative value right now, I guess, on the table, is it more, given the fact that Europe's outperformed substantially, do I look back again at U.S. equity markets, and do I go down that market cap ladder for the opportunities? Yeah, where are the gems there?
So, David, I think there's a lot of places to find opportunity in markets right now, which is a great thing. I think if you go down market cap, both within the U.S. and outside the U.S., plenty of opportunity. I also think Asia, multiple markets within Asia, offer tremendous opportunity. I think Japan is really looking intriguing. There, the corporate reforms and the societal reforms have been significant over the last 5 years. They'll continue to take pace. We're seeing the bid for Toyota Motor, for Toyota Industries right now. I think it's a continued notion of governance and change, potential significant change in Korea, which I think is long overdue and could certainly be a catalyst there. But we're also seeing that throughout Asia as well. India continues to be a strong power. Singapore continues to attract capital from all over the world. And then lastly, China, the world's second largest economy. There's still plenty to be done here. Look, the economy's weak. There's tons of structural issues there. That said, there's plenty of firepower from the government to be able to reorient things. And once this tariff impasse gets hopefully to a constructive outcome, you're likely to see the big if. I would tell you that I think that if is probably not as big as people think it is. I do think that it's in both countries' interest to come up with a constructive solution, right? A destructive answer is terrible for both, and I think there's plenty of room for reasonable compromise. I think Xi and Trump speaking together will help facilitate that reasonable compromise. Maybe I'm being optimistic, but I do think that this will occur. But I do think China, again, is awfully interesting, and the degree of pessimism, as reflected in market multiples, we're now at extremes. We're multi-standard deviation events away from where history is. If you value it on a cash flow basis, you're getting fantastic cash-on-cash returns. Again, lots of weakness in the economy. There's still structural issues. But all of that is overwhelming the notion that there's really some good things and some great companies to invest in as well.
Based in the U.S., though, I'm wondering what's the perspective you get from your clients about how receptive are they to the whole China story now?
So it's really bifurcated. And I mean by bifurcated in that most of our clients are awfully intrigued by the opportunities in China. Some great companies, a fantastic market, world-leading competitive advantages for a lot of companies, and we understand how big that market is, right? It's scale in and of itself. The concern is more from not just a tariff perspective, but almost a U.S. regulatory perspective. You're hearing news about delisting. And while delisting has been moved off the table in terms of there's the ability to go ahead and reallocate capital to Hong Kong, the bigger risk is blacklisting. And so you as a U.S. investor, you don't know what that risk is. It's not zero. It may be small, but again, it could be catastrophic if it occurs. And that has chilled U.S. investors' allocations into China. I think if that gets off the table, you'll see a significant warming to it.
Yeah, I was going to ask you if you see well, I guess short term, do you see the possibility that U.S.-based investors further warm up to the idea of China? And I think the other side to that question is because of what's going on between Beijing and Washington, do you think that longer-term increase is simply the home bias of sort of the two bases of investors, U.S. for U.S., Asia, Chinese for China?
I think the answer is it depends on what happens with these conversations now? Is there a rapprochement? Is there a détente between the two countries? If there is a détente, if there is a rapprochement, I think you'll see a greater warmth between the two. We're right now at a very critical point, right? It is the tension, which has been significant for the last 8 years, has escalated more recently. If we get past this point, you will have gone past the biggest threshold issue, and then I think people, in both countries will feel comfortable allocating capital to both countries right across. If we cannot get past this point, then it will be politically unfavorable in both places, and so you will accordingly have people pull in. I think people want to cooperate.
Yeah.
But governmental policy is not my specialty, and we'll have to see what that is.
Well, okay, not to ask you about politics and government policy. We have elections in South Korea, but just to ask you about the market. For foreign investors, is there a play in Korea beyond semiconductors, which is like the sort of top line attractiveness of that market?
I think there is, and it does depend on governmental reforms here. I think Korea is a fantastic country and fantastic market. The corporate governance there has been the biggest challenge to investing, and the one place where I think foreign investors have been able to allocate capital and get comfortable is in the semiconductors, SK Hynix and Samsung in particular, because they're such global leaders. You'd love to invest more within Korea, but the lack of corporate governance, the lack of protection for minority shareholders is a true concern. And so how do I allocate capital to Korea knowing that corporate governance may not protect me as a minority shareholder like it would here, for example, in Hong Kong, or it would in other developed markets? These changes are significant, and I think you've also seen the power of investing behind this long term. So we saw the real change in Japan over the last several years. That has catalyzed significant reform as well as economic growth and market acceleration. Korea certainly has that opportunity.
George, it's great to have you here in the region. George Maris there, CIO and Global Head of Equities at Principal Asset Management. And still ahead on the China Show, former Morgan Stanley Asia Chairman Stephen Roach joins us to discuss why he's revisiting his declaration that Hong Kong is over. Yeah. He has a new take on it.
Slightly changed his
Slightly
mind.
changed. Not yet.
Not completely.
Yeah.
Anyway, he'll tell us more.
Some stocks to watch here. New World shares. We're seeing a bit of a bounce back there after what we heard yesterday. And also concerns about not paying that coupon, those perpetual bonds here. So a little bit of recovery here as well. But we're watching the whole property sector in Hong Kong. Mixed picture across some of these Hong Kong names as well. Sun Hung Kai actually doing decently well. But Hang Seng also up in the pre-market of 0.5%. The open is next. You're watching the China Show. We're kind of on the open of markets and the reopening of mainland markets here after coming out of that Dragon Boat festival or holiday, I should say. And certainly we are seeing a little bit of upside, I guess, for pre-market in Hong Kong. But we might likely see a catch down story just given what the market in Hong Kong was dealing with yesterday, right? Trade frictions are re-emerging between the U.S. and China. That seemed to be the biggest overhang across these markets yesterday. Although futures are pointing a little bit more positively here today. The currency continues to see some strength here at 720 here right now. But yeah, a lot of questions about not just what we're seeing with New World, but what does this all mean? Is there the spillover effects of New World to the rest of the credit space?
Yeah, I think the drop yesterday on the HSP, the Hang Seng Property Index, was over 1%. We haven't seen a move like that, I think, in a couple of weeks. In New World's case, I think we're up in the pre-market. We should be up. You should be seeing that on your screens quite soon. The drop there was the biggest on the stock. Of course, it's more a fixed income story than that. Biggest since about early April. Yeah, so the fact that we are getting we're looking literally at the schedule of upcoming coupon payments for those perps coming up. Just underscores the nuance that needs to be hit on that story.
And there you go. You see it in the A-share market. We're just slightly to the downside here this morning, so we're not seeing too much pressure. But we're watching very closely what happens when it comes to some of these tech shares. That certainly was where we saw most of the sell-off yesterday in Hong Kong. But so far, CATL is doing decently well. These are the A-shares as well. And we are also watching their Hong Kong. There you go. Doing much better than yesterday. We're up about 0.75%. HS Tech seems to be catching a bid here this morning as well. We focus on the Hang Seng property space, as Dave mentioned, because of New World. We're still seeing some decent gains on that index this morning. And the tech space seems to be recovering a little bit as well. Currency in China also continue to strengthen. As Dave mentioned, we're approaching those 2023 lows for the dollar as well. Take a look at how some of the A-share listed developers are doing in China, because yesterday, over the weekend, I should say, we got some pretty bad numbers in terms of home sales, that big slump in May. So we are seeing a bit of fallout there in some of these property developers here this morning. And once again, we have to take a look at New World. We talk about the shares actually recovering, but yesterday it was really what we saw in some of these perpetual bonds, which did briefly touch those record lows. Recovered slightly towards the end of the session, but yes, a lot still of questions lingering with this company. Dave?
Yeah, I'm just looking at my screens right now. When we look at that 5% recovery in the stock, I'm just looking at some of my charts here. We're looking at the I think it's a 618 coupon. Give me some time. This is live TV. But yeah, let's bring the team together, and we'll show you that in a moment there, because we did see a drop, of course, Friday into Monday on many of those fixed income securities. Our team is here to talk us through this analysis and the latest. Shirley Zhao, of course, out of our consumer and gaming report, and also our Bloomberg Intelligence Chief Asia Fixed Income and Credit Strategist Timothy Tan also joins us for more analysis on this. Shirley, let me start with you. The latest piece you guys put out, there's this big mall that they're constructing. It's constructed, I think is the point, right across the airport. Why is that relevant to the broader story of New World?
So the airport mall measures about 3.8 million square feet, and that accounts for about a quarter of the total square footage of New World's major investment properties in Hong Kong. So if that project is successful, it can provide a stable and recurrent liquidity for New World to ease its cash crunch. So we know that New World is facing increasing debt pressure right now. So it's deferred payment on interest for some bonds, and it's also seeking urgent refinancing from banks, and it's pledged some of its most prized assets for that refinancing. So the project really is key in sort of improving New World's financial health, and if it fails, it could deepen New World's financial troubles right now.
Timothy, I want you to chime in. I mean, obviously, we've been questioning why they defer this bond payment. Why do you think so, and what do you think is next?
Well, largely because, as she was saying, you need to preserve liquidity. And one of the big issues has always been the refinancing risk, right? Because they need to refinance the loans and the bonds. Now, the loans are predominant at this point. Now, by putting in security in all these assets into these loans, it's quite likely they're going to get the loan back. The whole $87.5 billion of loan into their books. However, that also means that the banks have much more severe covenants. They're going to try to control their cash. Now, they will defer what can be deferred until the cash flow improves. And that will be the perpetual bond deferrals and dividend deferrals. So it's a natural progression of what's going to happen. Yeah, and obviously that's going to have a negative impact on perpetual bonds and on equity, because you're not going to be getting dividend for a while.
It's really about managing scarce resources at this point in time. Talk to us about the financing, this massive amount of financing. You alluded to that earlier.
Yes.
That if they secure that, obviously a good thing.
Yes.
But what does that mean for holders of different securities down the capital structure then?
So by securing the assets, they have basically subordinated all the unsecured bonds, the dollar bonds, or whatever currency bonds that they have outstanding. So these will need to reflect the subordination. Now, previously it was unsecured pari passu with banks. It isn't now. So naturally, the bond prices should drop as credit risk rises and recovery risk rises. Yeah. So,
keep going.
Yeah.
Finish thought.
So at this point, the ones that are going to get hit most is obviously going to be the perpetuals, because frankly speaking, there's no repayment schedule, right? It's only based on call. If they want to call, they can call. Otherwise, they'll just up the coupon and let it extend to whenever we may be, 100 years or no, who knows. So these are going to be the one that's going to be most reflected in terms of price drops. Not to mention the US rising yields is not exactly great for perpetual bonds. So the others which have fixed maturities may be slightly better off, but again, fixed maturities require refinancing as well, right? So these bonds at some point may be renegotiated at some future stage to see whether they can be included in the security, or they may be replaced by loans if they can still borrow more money from the banks.
Do you think that they're able to ring fence this? Obviously, I'm just wondering, the Cheng family, are they trying to preserve some of his other business empires, Chow Tai Fook, for example, or do you see more spillover from this?
I don't see a spillover because it's a new world problem. Okay. The big issue is that the Hong Kong assets may be doing reasonably okay. It's their China assets that are actually creating most of the stress. The returns on the Chinese are very, very low relative to peers in Hong Kong. So at this stage, I think their cash drain is coming out of China. Any improvement in China would be a great plus for them, actually. Yeah.
What's next, Shirley? What else? What have we missed here?
Well, so we learned from sources that New World's management is really growing, increasingly concerned about its airport project. They call it 11 Skies. Yeah. And, they invested $2.6 billion US in building that project. And they successfully bid for the project in 2018, where Hong Kong's economy was totally different from nowadays. Right. So they envisioned that the project could become like a must-go destination for Hong Kong, and it could become a huge success because mainland Chinese shoppers then were still shopping expensive items in Hong Kong, and they're splashing out. But nowadays, mainland shoppers are no longer coming to Hong Kong just to shop for luxury. They're coming to Hong Kong for experience, for sort of, travel, and they're taking selfies at Instagrammable spots. So a mall at the airport no longer makes that much sense in today's Hong Kong's environment. And of course, retail has been in decline. And that airport project has been part of the problem that sort of created New World's debt pressure right now, because New World was expanded so quickly. It went into heavy debt back in 2018. And it followed immediately by months of protests in Hong Kong, and then 3 years of COVID closure. And then, Hong Kong's interest rate hiked, the global interest rate hiked. Right. And then, New World, that's why New World got into the trouble that they got into today. And with the Hong Kong's prospect becoming much weaker than before, the management are finding it difficult to persuade tenants for the airport project to move in. And the airport authority, we learned from sources, is also having difficulty in persuading airlines to move flights into the second terminal that's adjacent to the New World Mall. So a lot of airlines are feeling that the demand is not where it used to be, and the second terminal is a bit too far away from the main facility of the airport. So they don't see much need to move into the second terminal, even though, the airport authority said they have already persuaded about 10 airlines to move some flights into the terminal. We learned that the airlines do have these concerns. So that's why, New World's management and the airport authority executives are becoming more concerned about this project.
Okay, there's a lot of challenges ahead, it seems. Yeah. Shirley, thank you. Shirley Zhao there, our conglomerates, consumer and gaming reporter. And our thanks to Timothy Tan, Bloomberg Intelligence Chief Asia Fixed Income and Credit Strategist. And later on the China show, we'll be speaking with CreditSight's head of East Asia Corporates and Asia Credit Strategies, Zerlina Zeng, on more on this New World story as well. We got some RBA minutes to tell you about here that just crossed a few minutes ago. So, yes, they did go for that 25 basis point cut, mind you, in the last meeting, but the news is they actually considered cutting rates by 50 basis points last month to provide greater insurance against maybe a U.S.-led trade war. But ultimately, they decided to go with something of a predictable quarter-point cut there. So certainly that's one thing, and why maybe you're seeing a bit of a weaker Aussie dollar here this morning. We got plenty more ahead. This is Bloomberg. Well, big story coming out in the terminal yesterday was what we heard from Stephen Roach, right, the former Morgan Stanley Asia chairman, revising his declaration that Hong Kong is over. He now says he's seen the city being reinvigorated by U.S.-China tensions. Now, that's something that Roach says he didn't expect when he wrote that column last year in the FT entitled, "It Pains Me to Say Hong Kong is Over." The city has seen a rush of funds into the stock market this year. I'm pleased to say that Stephen Roach joins us now live. Stephen, it's always great to have you. And obviously, we had you on the program a year ago when that column came out. Since then, maybe tell us kind of the timing of all of this and what's really changed in your view that maybe things might not be as bad as it looked.
Well, far be it from me, and thank you. It's good to be back again, Yvonne. I figured after I wrote that piece, you guys never wanted to talk to me again. But, and far be it from me to throw cold water on a great Bloomberg story, but the case that I made in the FT had three legs to the stool. My concerns over domestic governance, the tight linkages to a weak Chinese economy, and the notion that Hong Kong would get caught in the crossfire of the U.S.-China conflict. Those first 2 points, I'm afraid, are still very much intact. But the third point, getting caught in the crossfire, if I had to write the piece again, I would take the word caught out and say that Hong Kong is benefiting from the crossfire as more and more Chinese and other Asian companies are interested in listing in Hong Kong, and investors around the world, but especially in Asia, are embracing a sell America mindset for a variety of Trump-related anti-globalist reasons. And so the Hang Seng has really surprised on the upside. It's up 50% from, I think, early January. But, again, keep in mind, it's still down 25% from the early 2021 highs, but this is obviously a strong bounce, and who knows how much further it could go, especially given the negative political developments in the United States. If the U.S. Congress were to vote today, they'd vote to have all Chinese companies delisted from U.S. exchanges. And again, that probably would benefit Hong Kong.
Stephen, David here. I guess just to build on that, you mentioned three parts to the three legs to the stool. One obviously is to the point you're making now is benefiting Hong Kong. I'm curious how you're thinking about the other two right now. Do you keep an open mind that those two could change?
David, I keep an open mind that anything can change, and in my long career, I've certainly seen that. But I think the domestic governance issues are still a very disconcerting negative against Hong Kong. Since I wrote the piece 14, 15 months ago, more than half the foreign judges to Hong Kong's High Court of Appeals have resigned with some very direct critical comments about their concerns over the rule of law. And there's no shift, in my view, of the extremely tight linkage, the second leg of the stool, between the Hong Kong and Chinese economy. I note with interest that just got another report, I don't know, 24 hours ago, of the 14th consecutive monthly decline year over year in Hong Kong retail sales. Yeah. The growth risks to China, I still think, are worrisome, and the tight linkages between the two economies is unbelievable, and it's hard for me to imagine a spontaneous revival of the Hong Kong economy in a weak Chinese economic climate. So I'm open. Show me the the evidence, or give me a new consideration to factor in. But so far, those two are still working out pretty much as I had anticipated when I originally turned negative.
Stephen, I want to get your take more on that one leg that's working, right? The share raising, the IPO activity, and the quality of listings that are coming here in Hong Kong, right? It's very tech, very innovative companies that are coming here, and what maybe Hong Kong Exchange has been wanting. Is this a sign that at least Hong Kong is successful in acting as that financial capital between the East and West? And are there risks to that?
Well, I think it's certainly a testament to Hong Kong. Historically, Yvonne, has really been a thriving market for IPO activity in Asia. But you spoke as that role being a bridge to the East and the West. I would probably be a little bit more regional in naming the role. I think it's a bridge between China and the rest of the world's capital markets, who prefer to go through Hong Kong rather than a very inhospitable U.S. Capital market environment right now. I think, as the capital market climate in the U.S. Continues to be a very treacherous place for Chinese listings, Hong Kong is a major beneficiary of that trend.
Stephen, next week we'll be speaking with Paul Chan, the Financial Secretary of Hong Kong. And this is actually a question I plan to ask him. If his team is watching, here's the heads up, I guess. I think just to build on Yvonne's question there, right? So clearly it's a good thing that Hong Kong, its proximity to China, its position right now. And I'm wondering now what the disadvantages are of perhaps just the perception that Hong Kong is China's international finance center first and global international finance center second. If you could distinguish the two things, is there a difference between the two things? And do you think Hong Kong should more actively promote its non-China portfolio?
Well, look, I think Hong Kong can be a strong platform for Asian listings outside of China. There's no question about it. But the idea that Hong Kong can serve as a capital raising platform for Western companies, especially those in jurisdictions that are aligned with the United States, I think is a real stretch. I'm sure the financial secretary will speak eloquently of, again, Hong Kong as a global platform. But, if you look at the IPO activity to date and prospects of what's in the pipeline, I think it's very much dominated by China and Asian-centric companies.
Stephen, before we go, I kind of want to switch topics here on something that is also that's been very timely about what we've seen with President Trump and his calls to cut foreign student numbers at universities like Harvard. As someone that is a fellow at Yale, I'm just wondering your overall response to this.
Oh, it's terrible. I mean, it's just, one of the worst things that I've ever seen a president do in my lifetime. I mean, one of the great attributes of the U.S. educational system, and I see this every day at Yale, is a thriving cross-cultural climate with students from all over the world. And, I've taught over the years large numbers of outstanding, intellectually curious, very smart Chinese students. And I would certainly hate to see that vanish from the scene. And I think it's a terrible thing that the Trump administration is doing in restricting that possibility in the future, and I hope it gets tossed out in the courts.
Stephen, let me take this specific issue, and then let's look at the broader sort of trade negotiation conversation. As you know, I think businesses are trying to figure out how to react to the present and plan for the future. And I wonder how you think about what's happening right now. Do you think these things will outlast the Trump administration? Is this something that you think will continue, whether that's what's happening in the academia or this sort of untangling between U.S. and China, to varying degrees, of course, on trade, but security perhaps most extreme? You know, what level of permanence do you see beyond the next 3.5 years?
Well, it's a great question. I mean, there are two aspects of the question that I would just focus on. One, the degree of policy uncertainty that is an outgrowth of a U.S. president who changes his mind multiple times a day. That is very Trump specific. And when he goes, I think we'll then go back to a more predictable policy climate. And uncertainty, of course, while it's going on, freezes the ability of businesses to make long-term planning decisions with respect to capital spending, hiring, and foreign sourcing. The second aspect, though, that's really probably more important is just to note that, you know, during Trump's first term, we were shocked with the tariffs that were put in place by President Trump in 2018 and 2019. But even more shocking was the fact that his successor, Joe Biden, kept those tariffs in place. And so post-Trump 2.0, given the very worrisome bipartisan anti-China sentiment in Washington, you know, it's quite conceivable that U.S. policy will remain tough on China for the foreseeable future.
Stephen, we got to leave it there, but thank you so much. Stephen Roach there, senior fellow at Yale Law School, joining us there from Connecticut this evening. I just want to break these recent data that came out from Caixin China manufacturing PMI numbers here. So this was quite a miss, in fact, 48.3. That is a big miss from what the economists were expecting here, and the lowest number we've seen since September of 2022, and missing all forecasts here. So we'll continue to look there, but yes, 48.3 for that number.
I'll put this together with the ISM imports out of the U.S. overnight, lowest since 2009. So clearly, both economies are feeling the headwinds from negotiations on the trade front. Plenty more ahead on The China Show.
Welcome back to The China Show. Here's a look at the CSI 300, a half hour into the session after returning from that holiday. And we are actually seeing a slight bit across equities there. In fact, you look offshore, things are looking a little bit better. And we are seeing a decent rebound underway for MSCI China. We're up some 1% as well. There is news, of course, that there might be some potential call between Presidents Trump and Xi. I think that's what's lifting sentiment here this morning. But again, you got to recap what we saw in that Caixin China manufacturing PMI. Pretty ugly number there, Dave.
There is an economic incentive that's come through on the data front for them to really hammer
Both
things out.
Both sides need this talk.
They need to find a solution sooner rather than later. The other point, though, that our China correspondent Min Lo mentioned in the last hour was she's glanced and she's surveyed Chinese media today, and there doesn't seem to be any indication that there is, I guess, the possibility, at least, or a near possibility, that we might see the two leaders meet. Now, all that being said, it's also worth pointing out that on the same week that we did get those talks in Geneva, there was very little indication that that would happen. And then suddenly we had news, of course, that they would. So just to caveat that, to Yvonne's point, PMI missing all estimates, lowest since 2022. U.S. ISM import data coming in, lowest since 2009. So underscore that point that they were just making there earlier on. Right, let's look at TSMC. Reason we're looking at that too, we're up about 1.8%. Number one, the tech rally overnight is carrying through as far as tailwinds go today. Apart from that, we're also hearing from the CEO talking about how profit will reach a record high this year. TSMC's technology will not leak amid the global expansion, amidst these talks and conversations around them putting, of course, more manufacturing hubs in other parts of the world. And I think they're also talking about gross margins here down 3% because of, again, the Forex impact, which, by the way, is something I think we should note going into the next earnings season of Taiwan with the strength in the Taiwan dollar.
Yeah, how is that going to be reflected into to earnings margins, the like here? Certainly is one thing to watch. You mentioned New World, so today we are seeing a recovery in that stock quite a bit here. So yesterday the news was, of course, they deferred that bond payment of their perpetual bonds. What we're seeing now is that New World shares getting, as Morningstar says, the company could avoid a default. And I think some of the analysts' notes that we've seen saying this isn't really a default, right? It might just be something that they need in terms of liquidity to buy some time as they go through this kind of refinancing and the bank commitments that they're likely, according to our sources, have solidified at least about 60%. So, yeah, maybe that's why we're seeing a little bit of relief here today in that stock, but then again, we're still watching a lot of volatility in the bond space. Yeah,
I think the last we traded on one of the four perpetuals that was caught in the crosshairs, of course, from the filing on Friday, actually closed at about 35 cents. So that's obviously gives you an indication of how far we've come. By the way, since late last week, we were trading at about over 60 cents. We're still waiting for this to come online, but that said, the story's not over, I think, as far as that is concerned. Right, across the region you have two markets shut today. You don't have Korea, and you also don't have Thailand trading. Apart from that, we are looking just about good across the screens. Of course, we talked about TSMC and the Taiwan story, 1.2%. I would imagine that's really doing most of the heavy lifting. 0.4 to 1% to the upside. We were steeper on the curve. We're now, as you can see, the opposite of that. It's worth pointing out the RBA minutes which came out opened up the possibility, but they decided against it, of a larger cut the last time they moved, but they chose to go 25 instead. Gold catching a further bid, 3,400, and we are making, again, a third approach to those all-time highs as we look at the U.S. dollar weakness coming through as well. Right, very quickly, in the next hour is the next indication of this sort of one for the bears. Bid to cover on JGBs. The 10-year is being auctioned today. Last one had the lowest bid to cover going back to 2021. Further drop in that takes you all the back almost a decade here as far as demand is concerned.
Yeah, so we've seen the last two auctions in the long end created quite a bit of turbulence. We'll see if this one does there. But this could be the 10-year more of maybe broader what sentiment is looking like here today, especially when it comes to the JGB market. For more on the markets, let's bring in our MLI strategist, Mary Nicola. So, Mary, obviously trade tensions seem to be easing off a little bit. We have this JGB auction as well. I mean, what's top of mind for you today?
Yeah, I think the key focus today is just really on the JGB market and what's going to happen with the JGB auctions, considering the pressure that we've seen on Japanese bonds over the last few weeks. Obviously, there's concern about debt sustainability. There's also more pressure on the Ministry of Finance to tweak sales of bonds and to tweak issuance, and of course pressure on the BOJ to change what they're going to do in terms of when they're unwinding their balance sheet. So there's a few steps, and there's no clarity as of yet. Even we heard BOJ's Ueda speak this morning. There was nothing to that effect. So there's a lot of nerves and a lot of angst going into the JGB market and the JGB auction. And of course, that's also what we're seeing as like the clear underperformance in the yen.
Mary, just to put together also, and I guess more on the equity side of things now, the data overnight from the U.S. ISM, and just in the last 15 minutes, the PMI numbers out of China, the numbers have really started to deteriorate on both sides, and fairly quickly. How do we need to be thinking about that moving forward?
Yeah, it's clear that the trade truce really hasn't done much in terms of improving sentiment for businesses. And the fact is that it's only a temporary reprieve because we don't know what things are going. So it's hard for businesses to plan if you only have 90 days of reprieve and how things are unfolding because of trade policy being highly uncertain. So what we've seen indicative for today is that from China specifically, you will need to see more stimulus. There's going to be rising expectations that more stimulus will come through from the government side because, yes, we saw a slight improvement from the official PMIs, but the fact is that small and medium-sized businesses and the private sector is struggling. And so as a result, we are going to need to see a lot more support and expectations of a lot more support coming through from the government to really stem these declines and to offer some boost for growth.
Mary, thank you so much. Mary Nicola there in Singapore for us. The other big story and one market that is shut today is South Korea as Koreans are headed to the polls. They're voting today for a new president after last year's short-lived declaration of martial law, still continuing to permeate as a fairly major issue going into the exercise today. And, of course, that eventually led to the downfall, of course, of Yoon Suk-yeol and certainly the country's worst constitutional crisis in decades. Danny Thomas is with us out of Seoul to get us up to speed where we are, and live pictures, of course, we're seeing on the screens here, Danny, of what's taking place in your side of the world here. What are the top issues you think that South Koreans are voting for today as they make their decision here?
Yeah, so clearly for everybody right across, it's just the economy, which has really been underperforming, and for every voter that has participated in opinion polls, they all have come out pretty strongly saying that we need a government that can stabilize the economy and put the country back on growth. And with that also comes the whole discussion with the U.S. Trump administration on tariffs. So those are the two main issues that people have been raising and trying to, raise in these elections.
What about for a foreign policy perspective? How does that shift depending on who wins, Denny?
Yeah, so that's a good question. And if you see the frontrunner Lee Jae-min, he has been slightly more opposed to rushing to a deal with the U.S. He wants a proper and a detailed analysis of what the deal should look like, and that could be a shift from the current government led by the conservatives. So if Lee Jae-min comes in, you're going to see a bit more of a pushback to Trump's kind of the threats. So that's something we will be watching out. And on the other aspect of it, Lee Jae-min has also been a bit more open to the idea of negotiating or being in touch with North Korea, which has been completely opposite to what the previous government has been doing. So those are the big shifts that you could see that comes through in this if the current winner and the leader candidate in the opinion polls gets to power.
Danny Thomas there. Thank you so much for joining us live from Seoul here this morning as voting is underway in that country. And, of course, we'll bring you the latest once we do hear more from this election. But it really brings a lot of questions, Dave, on just the overall outlook of Korea, right? You mentioned a really good question to George Maris from Principal about is there any sort of value for foreign investors beyond just the semiconductor space? And he says, look, there is. But you have to see more reforms.
Yeah, there's still some questions around how minority investors are protected, right?
Yeah.
And that goes into the broader initiative that they want to improve corporate governance, right? So beyond the usual names, there is value. The market is cheap. There is a discount there. But I think he was pointing out we need to see more reforms from the government itself to address some of those issues there. Let's split it out, guys, if we can, in fact.
You'd love to invest more within Korea, but the lack of corporate governance, the lack of protection for minority shareholders is a true concern. And so how do I allocate capital to Korea knowing that corporate governance may not protect me as a minority shareholder like it would here, for example, in Hong Kong or it would in other developed markets? These changes are significant, and I think you've also seen the power of investing behind this long term.
And he basically said Korea has to evolve in some ways, right? If you want to be able to attract international capital, if you want to be the likes of China, the being likes of China, being likes of Japan and Taiwan out there, you have to really, evolve and find itself, differentiate yourself in some ways. But he says, what he saw in Japan is really what he thinks could happen to Korea, basically, right?
Yes, yeah, and I think that's a good way to put it, right? That's the North Star of Korea, and I think the other comparison he made just now in the soundbite was, I'd rather take my money to Hong Kong for investors because there seems to be more institutionalized as far as those two North Stars are concerned. Anyway, we'll continue the coverage around elections coming through. In fact, just coming up here on the show.
We've been without leadership for the last 5-6 months, and it's been troubling, especially with the economic situation globally. And now with new leadership coming up, I think that will be the priority for the government.
That was Korean Air CEO commenting on the political situation in South Korea. We'll have more from his interview coming up. This is Bloomberg.
Welcome back. You're watching the China Show. Secretary of State, U.S. Secretary of State Marco Rubio has ordered further scrutiny of the social media policies of any foreigners seeking to visit Harvard University. And he's told actually U.S. consular officers that the lack of an online presence might be enough cause to deny a visa. Min Min Lo, our China correspondent, is here with that story. Gives a bit of background, Min Min, on this specific issue and, who might likely be affected and what's the broader sort of economic impact from this exercise?
Yeah, this latest directive from Marco Rubio is targeted at people wanting to visit Harvard. So whether it's faculty, students, or tourists, but of course, there is a broader targeting of Chinese student visas as well. And to give you some context of the scale, 1.1 million, that is the number of foreign students in the U.S. last year. India is the number one source of foreign students, and China ranked second. There were close to 280,000 Chinese students in the U.S. last year. And I want to show you another number, the services surplus that U.S. runs with China. It has a trade deficit with China, but a services surplus, and that is $32 billion. That's the amount of services sold to China last year, and nearly a third of that is related to education, whether it's tuition fees or living expenses of students. And bear in mind, many of these students, they pay full tuition fees, and that's the money that billions of dollars going to U.S. universities that can be used to provide financial aid to other students. And flip the board, you can see this is the reaction we're getting from China. A CCTV state TV anchor mentioned this, 烧掉吹灭别人的灯，烧掉自己的胡子, and it means essentially, you can read the translation here, it means it's a lose-lose for both U.S. and China.
Interesting. Very poetic. All right, Min Min, thank you for that update on what we're seeing here at China Correspondent. And, there are some universities out there that are opening their arms and welcoming Harvard students and the like, right? Hong Kong University of Science and Technology is one of them. They've extended an open invitation to international students from Harvard amid the current uncertainty. Joining us now is the university's Associate Provost for Institutional Data and Research, Alison Elizabeth Lloyd. Alison, it's great to have you here. Thanks for joining us. First and foremost, obviously, I think UST was one of the first to kind of raise their hand and extend that invitation to Harvard students. What sort of response and traction have you gotten so far?
Thanks, Yvonne and David, for having me. That is right. So we were the first institution to extend a welcome to Harvard students, but also students from other universities that have also been affected by this recent events. We have seen actually a lot of inquiries coming in. Students, obviously, as you can imagine, really quite grappled with anxiety and distress because they're quite uncertain about what will happen next. Can they continue their academic journeys? And so at this time, the university has really been trying to extend as much support as we can. As you've also mentioned, so we have been offering a variety of different types of support, including looking at ways that we can help with transition, academic bridging and so on, and many options. And in fact, the university has actually seen an increase in the number of international students that have been applying for undergraduate programs, if you look at sort of year-on-year increases. So definitely it's had huge impact.
Alison, I'm curious, you mentioned increase in applications. Could you give us a number or a rough number of how many people have actually approached the school since you guys raised your hand?
Well, the number is, of course, changing every day, as you can imagine, because with all the events that are quite dynamic. But I can share with you that in terms of applications for, say, our undergraduate programs, we've seen a sort of 40% increase at least. So quite substantial.
Interesting, 40%. Yeah, if you look at the makeup of Hong Kong UST, Alison, it seems like it is mainly, Hong Kong and mainland students that make up your student community. I'm just wondering, what does this mean for the university's broader agenda in terms of internationalization, and what challenges do you still face?
Well, the university actually has been quite steadfast to really try to create diversity within the student body. So actually, over the course of the years to date, what we've done is try to the mainland students may make up approximately, say, half of those undergraduate sort of body. We do try to diversify the other half, and so certainly that is something that we do continue to strive to do.
And Alison, do you think the objective of getting that ratio up, what do you think is the underlying issue why that ratio needs to get up in the first place? In other words, is that an issue unique to HK-UST, or is that simply, I guess, a challenge that many universities in this part of the world are also trying to get over?
Well, I think one of the benefits, of course, is we do recognize the value of bringing international students in. They bring certainly a different perspective into our classrooms. They enrich the cultural diversity on campus. So there's certainly great benefits to having that very diverse student body. It is something perhaps that a lot of institutions in Hong Kong are also quite mindful of. And as you probably are aware, the government has also encouraged the lifting of certain quotas for undergraduate non-local enrollment, and very much in line with this as well.
And can you tell us, obviously Hong Kong itself, the demographics have changed, right? The departure of many foreigners and the arrival of many mainland sort of people here based on government schemes, as you mentioned, like the Top Talent Pass scheme as well. I'm just wondering, to what extent do you think Hong Kong's change in dynamics or demographics is really impacting your demographics too?
Right. I think, despite the changes, I think Hong Kong still does offer quite a strategic gateway, right? So Hong Kong is still positioned very strongly as a financial hub, gateway to Asia, and particularly very strong, I would say, still in terms of networking career opportunities, particularly when it comes to, say, business, finance, technology. Hong Kong, you still see we're home to a lot of multinational headquarters, and it really is an ideal destination, particularly for students if they are interested to target careers in Asia Pacific. I think we still have that appeal for students to come.
Elizabeth, back to I'm curious. I just remembered a question I didn't ask you about the Harvard part of the question here. So clearly HK-UST, that really made the rounds when you guys put that statement out that you guys are welcome here. So simple question: how does that work? I'm sure they need to apply, but do they need to take a test? These are Harvard students, so I would imagine there's already some minimum level of intellectual capacity involved there. But yeah, how does that work? Are they in already, or take us through how the process should look.
Right. So basically, as you can imagine, so each student's circumstances is really quite unique. So what we've been doing is, these students reach out to us, and we have dedicated sort of counselors and advisors really understanding their various situations and what it is that we can perhaps best do to help, ensure that they can continue with their academic journey. So it's really quite varied what some of the different arrangements are. I mean, there is no particular test per se, but it's really understanding sort of how we can really best help. Because I think at this point in time, the priority really is to ensure stability for them, but also try to create some kind of safety network for them, essentially.
Okay. Yeah, certainly that's one thing to watch as well. So it'll be interesting. It's student to student, I guess, you could say. What does it tell you about just overall this whole issue with Harvard and the president? Does it really change how people view the U.S. as a destination for higher education?
Absolutely. I mean, I'm sure the reaction that we see is, of course, one of great concern and alarm, because essentially this really is a challenge, right, on institutional autonomy. It's a challenge to even the well-being of students and faculty. And I'm sure sort of going forward, you'll see that other than students being distressed about whether or not they can start their journeys there, continue, or even graduate, you even have, I think, impact on faculty who are facing frozen research funds and possibly even job security fears. I think most certainly when going forward, you'll have students certainly weighing the decision of how stable in terms the destination is, in terms of its policies, side by side with academic reputation when they are selecting an institution to go to. And I think going forward, you'll definitely see the rise of a lot of different talent hubs, essentially.
Alison, thank you so much for the time. I suspect this won't be the last time we'll be speaking. Alison Elizabeth Lloyd there, Associate Provost at the Hong Kong University of Science and Technology. And by the way, you can get an insider's guide to the money and people shaking up the finance hub. And certainly this is really a story that will continue to give as far as the Hong Kong story goes. Catch it every Thursday, our Hong Kong edition newsletter. Sign up via Bloomberg.com/newsletters.
All right, market check here right now. We're taking a look at TSMC shares in Taipei here, and we are seeing them gain about 1% here this morning. There was a talk from the CEO speaking at an annual shareholder meeting in Hsinchu and talking about, in terms of growth, sales will grow mid-20% in dollar terms this year. Also, what they've been talking about is they don't have plans for a factory in the Middle East. That was something that we had reported just a few recently here about maybe their plans to look over there. But certainly the CEO is squashing that idea, at least for now. Dave.
Yeah, I think that was the UAE was what we talked about in our reporting there. Right, just to flip the page, please, and we're looking at movie and film stocks and holiday box office data in China showing a 20% increase during the holiday weekend. Of course, so we are reopening, of course, for mainland markets, and we're getting some upside going against the grain across a market that's actually not getting a lot of momentum in the first hour of trade. Plenty more ahead.
All right, 11:29 a.m. in Tokyo. Japanese markets heading to that lunch break, and we are seeing at least a slight bit on equities there in Tokyo this morning. We're flat on the Topix, but really what we're watching very closely is, of course, the JGB market, because that 10-year bond auction is happening today. So we've been through two of the three, 20 and the 30-year, which were quite volatile in the last few weeks or so. We'll see how the 10-year and what it brings there.
That's a good point, because the last 10-year auction was clearly this time last month, and it actually took place before the series of weaker and weaker options, which I guess in many ways cemented the recent narrative of just a lack of demand there. So coming up on your screens very shortly is we've already seen bid to cover come in and trend slightly to the downside. In fact, the last one coming in at just over 2.5, which was already very close to the 2021 low. Anything almost below that, even slightly, would take out that 2021 low and take us back several years, which goes back to the 20-year, which was the lowest in 2013. The 30-year bid to cover was, I think, lowest in about a year or so. So yes, the BOJ steps away. We'll really need to see, I guess, more yields on the table for buyers to come back in. That should be out in about an hour from now. For the folks, of course, the next show with Haslinda. Anyway, that's for them to report. Anyway, well, that's a preview for you. Asia, outside of the Japanese markets, on a sector level, we're looking at a mixed picture. In fact, you know what? I'm gonna make this very simple. There's nothing happening in markets today, apart from the weaker dollar. But yes.
Yeah, it brings us time to look at what's going on with one property developer, right? New World. Yeah. Where we are seeing at least recovery in the stock here this morning. I think there's more analysts out there that are at least trying to provide some relief and clarity and saying, look, it doesn't look like this company is going to default anytime soon. And perhaps the deferral of these coupon payments is just a way to buy time as they deal with some of the refinancing, preserve some cash for the longer term. Let's bring in Zerlina Zeng. She joins us now from CreditSight on her take on all this. She's the head of East Asia Corporates and Asia Credit Strategy. Zerlina, thanks so much for joining us. You still have a hold recommendation on some of these bonds of New World. Can you tell us just overall what should we be watching out next after these coupon deferrals? And do you think that's a positive or negative thing for the company?
Yeah, thanks for having me here. I think it was a surprise for us because the fact this company actually has cash on its balance sheet. The operating cash flow year to date was actually pretty good. The company's contracted sales in China and Hong Kong were on target, actually exceeding the management guidance a little bit. So I think the trigger of this deferral was not a liquidity issue, but it is more for a precondition of the banks to grant in the company the rollover of the loans. I think people also need to be aware the context is the parental company Chotafu Group hasn't really provided any assets or cash injection other than providing a letter of comfort. Well, this is not very comforting for the banks. So I think banks at this point, they probably want the company to improve their cash flow to preserve some cash. So this is the resulting deferral of coupon. I think the next people should be watch out for is whether there will be a liability management on the dollar bonds, which we think is a base case. Because if I were a bank, I probably want to roll over the loan. I want to get the collateral from New World Development. Then afterwards, I would like New World Development to restructure some of its dollar bonds to reduce debt as well as to improve interest coverage. So this is probably the direction to go. But I guess everything has a price with the dollar bonds price dropping to this level. So that's why we are keeping the hold recommendation.
Right. Zerlina, David here. So is your base case that the group manages to get that loan agreement in place? And what do you think will be the loan covenants attached to that?
Yeah, I think our base case is still New World Development. They will be able to get the loan down because if it goes to an immediate default, then the banks will need to recognize a lot of NPLs and provisions, and they will be treated the same as the senior dollar bond holders, which is not ideal for the banks. So they need to get the collaterals first. I think in terms of the covenants, there will be some restrictions in terms of interest coverage, the company's solid plan to deleverage, and that also means the company do need to do some haircuts on the dollar bonds, because its free operating cash flow is still going to be negative for the next 1 to 2 years. So I don't think the company has other choice other than doing a liability management on its dollar bonds.
You mentioned that obviously the bond prices have gapped lower. Do you think that we've already reached a floor in some ways? Yeah. And what would determine that floor, you think?
I think we already reached certain floor at the market open yesterday. So the seniors tanked 20 points and the dollar bonds, some of them tanked 35 points, which just didn't really make sense because even in a liability management scenario, we think the terms would be better or the recovery would be better than the current market pricing. This is because, first of all, we don't think the company is insolvent, it still has cash on the balance sheet. And second is because if the goal of a liability management is debt reduction, then the company needs to maximize the consent from the bondholders, and you cannot be offering a very bad terms to get the bondholders buying.
Yeah, but Zerlina, the notion that if they are able to get the loan extension, don't these become subordinated then? And do you think that's properly priced in the market?
Yeah, I think the bonds are already priced as subordinated because the news that the New World Development is going to give collaterals to the banks. So it's already priced in to some extent, the structural subordination.
Right. And what do you think the future then is for these perpetuals? And do you think the company will simply just need to, I guess, in some ways refinance at higher coupon costs?
Yeah, I think the company will need to restructure the dollar bonds at the very least. I do see the chance of senior dollar bullets also get included in the liability management because they have two maturities in 2027 that are ahead of the bank loan maturity. I think the company will likely do some upfront cash payment, then they will defer the coupon payment as well as the accumulative coupon in the form of payment in kind. And then maybe in 3 to 5 years' time, they will start paying coupon on the dollar perps again. For the seniors, there could be a distressed exchange offer, or there could be also included in the liability management as in the extension of the maturity.
Zerlina, maybe I want to broaden a little bit more on what this means. I mean, some of these blue chip names in Hong Kong have had a pretty warm relationship with creditors for the past decade or so. I'm just wondering, does this change at all Hong Kong's reputation as a credit-worthy community?
I think for a lot of the high-quality Hong Kong property names and conglomerates, their stance in the bond capital market is still very strong. Names like Hong Kong Land, Wharf, they're A-rated, their balance sheet is rock solid, and they have very prudent financial management, and bondholders are okay with these ones. I think newer development is almost like an exception. Historically, it hasn't been very communicative with the bondholders. I think for a lot of our clients and investors, the IR and Treasury team, they just disappeared and stopped communicating. So I would say this is an exception. And I think for a lot of the IG and high-grade Hong Kong property credits and conglomerate credits, the reputation is still very good and the stance is still there.
Final question for you. Can't let you go without asking a broader, just what's your investment advice question. So we know Treasury yields have been pushing the ceiling. We know at some point the Fed is probably going to cut. What's best value right now across the fixed income space? Rates, IG, high yield. What's a mistake and what's a good idea?
Yeah, I think we hold a very contrarian view of the Fed on hold throughout the year. Everybody think we were crazy at the start of the year. I guess we're not that crazy anymore. So as of now, we are getting a bit more comfortable with duration than credit risk, given U.S. Treasury has sold off in April and in May. And in terms of the credit risk, we are cautious. If we look at the Asian IG and high yield spread, they have already reverted to historical ties before the Liberation Day. So we think we need to be cautious of going down in credit quality. We like a barbell strategy in credit risk, so we do have some defensive names in our portfolio. We also have some selected beta. One other thing to note is we always tell clients to diversify across different markets and also across different currencies, given the broken correlation between Asian rates as well as the U.S. Treasury. So I think diversification is quite key in portfolio allocation.
There you go, Zerlina. Thank you so much. Zerlina Zeng there, head of East Asia Corporates and Asia Credit Strategy at CreditSight. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show, right? So we went into the weekend, right, on Friday, and quite a change in the tone from both sides on U.S. and China. So what's happened? What's happened, right? So what we have here on your screens is a graphic, really, which underscores, I won't get into the details because, well, for one, these are words I can't even say on the most sober of times. But that being said, it effectively shows you the global market share and the dominance China really holds over the sector. In fact, Trivium China believes that Beijing's grip, and this graphic underscores that bit, right, on rare earth materials is boosting its leverage in negotiations. And Yvonne, we were talking just before we came on air that this really has emerged as one of the sticking points to these ongoing talks.
Yeah, in fact, we heard from Scott Bessent, the U.S. Treasury Secretary, recently speaking, I think it was Meet the Press, Face the Nation, sorry. He mentioned that there was signs that China was violating their part of the agreement in this trade truce. And when they asked and pushed him, is it because of rare earths? Is that one of those products? He said yes. So that certainly is one of the things that seems to be in a logjam right now. Let's bring in Martin Ritchie, who covers commodities for us out of Shanghai. And Martin, you know, we talk about rare earths. That is one of the big sort of key leverage that China really has right now in these trade negotiations.
Yeah, it certainly seems to have become the major sticking point of the moment between the US and China. Obviously, we had the big agreement in Geneva last month that reeled in those tariffs, really punitive tariffs. But since then, there's been disagreements on a number of fronts, and we've seen the US introduce a number of new measures against China, including new restrictions on Huawei technology use, new chip controls, and restrictions on US visas for Chinese students apparently incoming. So on the US side, they appear to be very unhappy with what China has done following that deal. And what they have done is becoming a little bit clearer with some of the comments from the US. They seem to be unhappy that China has not started shipping rare earths and rare earth products from China yet. The agreement in Geneva implied that China would stop some non-tariff countermeasures. What we're hearing from the Washington side now more clearly is that this does relate to rare earths. We heard Jameson Greer, the US trade representative, saying that China needs to do more to speed up its exports of rare earths. And it's slightly complicated because China, for its part, it started these new controls on rare earths to exports to all countries in the world, not just the US. So they've been introducing this new system to check exports more carefully, and that takes a while. So what we're starting to see now is some of those exports happening now. We had AmCham president, the American Chamber of Commerce in China, saying that over the past week there have been exports start. So we're at this situation now where the US seems to be complaining quite vociferously in public now about something which maybe is already starting to happen on the Chinese side.
Yeah, well, I was about to ask you too, like, do you get a sense that they maybe spoke too soon, because this is a fairly complicated process to get underway? And do we have a sense as well of what would appease the U.S. side in terms of, how much exports they actually want to see take place?
Well, the interesting thing with this is we've got a sort of model of what happens with export controls in the past. In the past year and a half, China has put export controls which are aimed at stopping military and defense uses, essentially, has put export controls on a number of other minerals and products. And what you see is there's a kind of hiatus of a few weeks to up to 6 weeks, where exports have to enter this new regime. Exporters have to apply for permits. They all have to get used to this new system of working. So there's a lull, and then exports start picking up again. It might be that we see the same with rare earths, and that certainly chimes with what I was just talking about. AmCham president saying the exports were starting again. What will actually appease the US is if those companies, those commercial companies like Ford, like the other automakers, start getting their supplies of what are called rare earth magnets, start getting their supplies flowing again and in the volumes needed. I know that Ford has already experienced some disruptions, just to give one example.
All right, Martin, thank you so much. Martin Ritchie there joining us out of Shanghai. Here are some of the global headlines that we're following for you today. Bloomberg has learned that the EU has agreed to curb Chinese medical device manufacturers' access to public procurement contracts. Now, sources say EU countries voted Monday to ban Chinese firms' access to public contracts worth more than 5 billion euros. An EU inquiry found that Beijing discriminated against foreign firms in procuring its own supplies of medical devices. Polish Prime Minister Donald Tusk says he'll seek a vote of confidence to shore up support for his coalition government. That's after nationalist Karol Nawrocki defeated a centrist candidate backed by Tusk's party in the presidential election. Tusk says he wants to reestablish unity in the cabinet, but has a plan in place if cooperation fails.
Now, let's stay on the election theme. You have South Korea, of course, today heading to polls to pick a new president. Now, the winner will face the challenge, of course, of reuniting the country after the worst political crisis in decades and negotiate separately, of course, a trade deal with the United States. Now, speaking exclusively to Bloomberg, Korean Air Chairman and CEO Walter Cho says securing a trade deal specifically needs to be the very top priority for the next president.
We've been without leadership for the last 5-6 months, and it's been troubling, especially with the economic situation globally. And now with new leadership coming up, I think that will be the priority for the government, Korean government. Yeah.
So getting a trade deal done, is that
Yes,
job number one?
Yes, I believe so.
And what do you want to see from that?
Regardless of the outcome, I just want it to be done, so we could see some future into and predictability.
So you'd rather the details are less important than knowing what the future is going to be.
So we can plan on what to do next.
Do you think the currency volatility is going to continue? The won's been pretty volatile over the last few weeks. Is that something that's affected you, and do you anticipate that continuing?
It's been stabilizing for a few weeks now.
So you'd be happy with a stronger won? That would be something that you would actually welcome?
Yes.
Do you think that will be part of the conversation with the United States?
But the Korean governments would, I think they would prefer a weaker won because it's an exporting country.
Yep.
But for me, I would prefer a stronger.
Okay. In terms of the trade deal, is it important to you though that we see aerospace being carved out? A lot of CEOs are telling me that they would rather make sure that actually that aerospace goes back to its original format, which is no tariffs. How likely do you think that is?
Well, we're a large buyer of aircraft, but we also sell a lot of airplane parts to Boeing and Airbus as well. So this is very important for Korean Air as well. So, and historically, aviation was not part of the tariff, and now that it's going to cause a lot of confusion to the business. Yeah.
Are you already hearing that we're going to see price rises? I'm talking to so the Boeing, Airbus, the big engine manufacturers, are they already starting to signal that price rises are coming?
Fortunately, we locked up all the prices before this happened, but I'm expecting some
spare parts and things like that could become more expensive.
Yeah, so that will be difficult to maintain and grow our business as well. Yeah.
What's happening with demand right now?
What?
Demand. What are you seeing in terms of?
So cargo, we've been seeing quite sharp decrease from traffic from China to U.S.
Right.
But and the passenger, it's been steady, especially in the premium market side. It's been steady, but we're expecting some turmoil depending on the trade negotiations.
The trade situation will also affect the passenger side of things. How exactly is that? Is it just in and out of the United States? Is it? Where are you seeing that?
Well, it's not just the United States, but it has a very big effect on the Korean economy, and that has a great effect on the passenger demands.
And you think again that's structural? That's a permanent feature of the landscape now.
Yes. So we'll have to adopt on that too, but there's too much to adopt right now.
There's too much volatility in too many parts of the business.
Yeah.
In terms, therefore, of going forward, how are you thinking about planning the network? How are you thinking about what you're doing with aircraft? Given the volatility you've described, can you make big orders right now? Do you have the degree of certainty you need to make big decisions?
We have demand for new aircrafts, not just for expansion, but also for replacement for more efficiency.
Yep.
And that's what we did in previous months with Boeing and Airbus. And we'll continue to do that. But for expansion and growth, there's still a lot of other markets that we are pursuing to grow and expand into.
Right.
Not just U.S., but other markets.
Okay, but you would take some capacity out of the U.S. and just put it elsewhere?
I think U.S. market is, I don't think we're going to pull out any of the capacity from U.S.
And that was a Korean Air Chairman Walter Cho speaking exclusively with us there. Plenty more ahead. This is Bloomberg.
All right, before we wrap things up, weakness in U.S. futures. We're doing okay, decently, not blockbuster. So I guess suffice to say we're a bad headline away from this reversing to the downside, a 1% to the upside, give or take here on the Asia-Pacific Index.
Yep, and up next is, of course, that JGB 10-year bond auction. And but we're prepared for some volatility after what we saw with the 30-year and the 20-year. And certainly, given the rise in Treasury yields, that's going to add to a little bit more angst in this bond market as well. So what is the bid to cover going to be? What's going to be considered to be high or low in terms of demand? And we're not done yet. There's another one on Thursday, Dave.
The 30-year is coming up on Thursday, also around the same time of the day. But that's it from us here in the China Show. You have to stay tuned for details on that bond auction coming through with Insight with Haslinda and team coming up.